Welcome to the Veronica Edwards Show, where we have fun, financial conversations that everyone listening can apply to their personal and professional life. I'm your host, Veronica Edwards, CPA, and today we are back season 6. This is our last episode of the season, but I couldn't imagine having anyone else other than friend and fellow CPA, Alanna Anthony, owner of Amplify Accounting and Consulting. And we are breaking down today all things taxes related to real estate. Alanna, welcome back to the show, friend. How have you been? You haven't been back on since March. We've been having crazy scheduling conflicts, but fill us in. How have you been?
I've been good. It's been busy.
Very.
But that's okay. But I've been good. I missed y'all.
We missed you. We missed our updates on all season. Alanna has been renovating her beautiful home in New York. Go New York Knicks. We've been talking about that Knicks too. Yes. So what's been going on? Last week we talked S-Corp, if you can even think back then, and that was in the middle of tax season. So since then, what's been going on in Amplify Accounting and just for you personally?
So the business will be fast. So at this point, we're in extension mode. So we have some extensions we're trying to knock out. But then also I'm just heavily on the tax planning side at this point, because normally people don't realize they need tax planning until after they file taxes. So that's what I've been focused on. Now, connected to the house itself, I'm focused on my office, which is looking real empty right now.
It looks beautiful, even blurred. I told Elaine, I said, I see some greenery. I see some grays, some whites.
Yeah, we got new windows in my office.
Ooh.
So I'm still moving stuff back in and really figuring out what the setup is going to be. The house itself, I want to say it's done, but it's not. For the most part, it is done. So both floors are done. There's just a few little touch-up things that weren't done that need to be done, like the fireplace. The mantle was scratched up during demo, so we got to do a little sanding.
Little cosmetic.
Little cosmetic.
Could the Edwards come and stay with you? If we wanted to come up to New York, go to a Knicks game.
We have room. We have space, right? We did figure, I don't know if I told y'all, I had a dresser that could not fit up the steps.
Ooh.
It's some good North Carolina furniture.
Come on.
You don't know, North Carolina is
Hickory.
The capital of furniture.
Yes.
So we tried to take the screws out. It still was stuck. Basically, the bottom of it is just a little too big. It has some crown molding. And then we try to use a heat gun.
Oh.
It's not working, so it's for sale.
Repurpose. This is what I'm hearing here. This is still, yes.
I'm trying to get it to the basement, but I don't know. Those corners is a little tight. You know what I mean? But other than that, it's good. The next project is, actually, we're getting more windows.
Windows are expensive. I just want to add that.
I equate windows to cars. I equate most things to cars. I like cars, if I've never told y'all. So
I didn't know you was a car girl.
I love cars. So when we got the initial quote for the whole house, I told my husband, I said, this is going to be an Acura MDX brand new base model. And he started laughing because he was like, really? So if you don't know anything about cars, Acura MDX around 52, maybe 55,000 base model, brand new.
Okay. A little above average what cars are coming out with.
Yeah. So, and it was. And so of course, they always throw in incentives if you do this, if you give us reviews and blah, 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 blah. We're still not getting all the windows done at one time, though.
I understand.
This next stage, we did these 4 because y'all probably didn't know this, but I was freezing all winter because 2 of my windows did not close all the way. So we had that, what do you call that? That paper, that clear plastic that you put up to keep the heat. Yeah, I had that up, but it really wasn't working. The radiator didn't feel like it was working. It was working, but it's just, counteracting that. Yeah. So now we're getting the whole first floor done and the front of the house done. Because truthfully, we probably should have got the windows done first. Just give you a little reno tip.
I was going to say, any advice, anything if you could change, if you would have done something different?
First of all, done first.
You moved in the winter.
The reason why I said that is because when you do all the work on the inside, if your windows aren't any good, then basically you could have leaks and things like that. And that's going to ruin whatever work you got done on the inside. Now, thank goodness we didn't have any of that happen, but we knew the windows was bad once we moved. Like, we knew they weren't the greatest. Like, we was like, oh,
Right.
we can wait a year. But as you live here and you're sitting in your bedroom
Getting
and
the
things are just
utility
moving,
bills.
it's just moving because it's windy through the windows.
But see, Alanna, this goes right into what we're talking about today, real estate, because
Yes.
you're a homeowner
Yes.
but you also have rental property in North
Yes.
Carolina. So this show is for folks, regardless if you own a home, if you want to own a home, if you have long term, if you have short term. So when we come back, season 7, Alanna, in the fall, September, October, can we get a tour of the house? That's all I'm saying.
You know what we'll do? I'll record a tour separately and then I'll give it.
Yes. Oh, we'll do a live.
Yeah. Now, I would tell you this, though. It probably still ain't gonna be finished.
Right. But you're getting closer. That's all it's about.
Yeah. The first floor is done. The second floor is done. Now I'm like curating furniture, but like down to the basement, I want to do some board and batten.
I don't even know what that is. So that
my husband thinks I'm doing too much, but
but see, these are things, you got the main things working.
Yes.
And then you can actually go in. But that leads us to real estate. And I'm so glad that you brought this up, because I feel like real estate is one of the best ways that you can build generational wealth. Like, you've put a lot of money recently, Alanna, I'm sure you're like, Lord help me, into this house, but it's yours. And you can pull from it. And so I would love for you to start us off on, why is tax planning so important? You mentioned that already when it came to income tax, but why is tax planning so important when it comes to real estate?
Well, because you really have to think about, well, first of all, I'm going to hit on one thing a little off. It's on topic, but off topic. You mentioned generational wealth. And I think a lot of times we think of generational wealth as like passing money on. But we also should think of generational wealth in the fact that, like, grandma's paid off house, somebody can live in that paid off house and just pay money towards the taxes, which is significantly cheaper than the mortgage. And so that is a way to pass on generational wealth. I know we don't think of it that way a lot of times, but it is, because the less money you're paying for your living expenses means that you have more money. And hopefully you use it correctly and like invest it and use it to basically bring in more wealth, build more wealth, but also bring in more income for yourself. So think of it that way. But then also when it comes to the house, is one thing I always hit on is the step up basis for inheriting a house. A lot of people don't realize that there's a step up basis. And so you can basically, if say, actually, we've been in conversation with my parents about this. So if my parents pass away, basically, we can inherit their house. Neither me or my brother want the house right now, but
oh, I'll take the house. I'm taking all the houses. Give me the house.
I said that too, but there's just one little issue that I think just all of us are like, we don't want to take that on. But basically there's a step up basis. And so when they pass away, basically the market value of the house is what the basis of the house would be. So I don't want you to necessarily turn around and sell it. I'm not a fan of selling grandma's house, as we like to say. But if you had to, because everybody's circumstances are different. And especially when you have, if it's multiple siblings and things like that. Matter of fact, I forgot, you're going through something similar, Veronica, or you're planning for something similar. You want to make sure you have plans in place so that your heirs will basically be able to take on your property and not have all of these other factors in place when it comes to taking over the house. So the step up basis allows you to take on that market value, which means that you won't have to worry about a larger, not saying it won't be there, but a larger tax implication if you do decide to sell it. That's something that's good to have there. But then also, that's mixing a little bit of estate planning, which is a part of tax planning, making sure everything's set up properly so those you love are able to take on the home without going through like probate and all of the other things.
Oh, I'm so glad that you added that. We're going to be revisiting estate planning with Insure with Andy, a new segment that we're going to have with Andrea
Yay.
Jones. Yes. And I'm glad that you brought that up when it comes to planning. A lot of times we just think, oh, we got this house and that's it. But we know there's taxes related to a house, even if it's personally. And we actually have a big thing happening in Buncombe County where they revalued all the houses so high that a bill was approved. Like, let's pause this because as we know, we might sell our house for $1 million, but the property tax isn't based off of that market value. And so with all that increasing, that changes your property tax. So I'm glad that you brought that up, Alanna. I did not know that about the step up that takes place when you inherit real estate.
Yes. It helps a lot of people out. A lot of times they don't realize that. It does make it a lot easier for them.
Yes. So let's talk about some of the tax benefits, Alanna. Let's get started with just a basic homeowner. They're not renting the property long term. They're not renting it short term. They're actually living in the home. What are some common tax benefits?
Well, of course, there's the mortgage interest deduction. Now, you only get this if you itemize. So a lot of people at this point feel like, I don't even want to say feel like they don't get it at this point, unfortunately, due to the changes with the Tax Cuts and Job Act back in 2018. But if you do itemize, which means you have enough write-offs that are higher than the standard deduction, then you can benefit from writing off your mortgage interest. And I also want to throw in there is that if you do not have enough deductions to do the itemized deduction, please still just do the standard. The higher deduction is what's going to benefit you most. But then you also have your property taxes that you pay. And that's a deduction. You're able to deduct that also. Now that is also based off of itemizing. Sorry, but
Right.
it is now higher due to the one big beautiful bill. As y'all can tell, I hate calling it the one big beautiful bill. In our world, it's called HR1, but I know that's what y'all understand. So
yes, HR1 sounds like the swan flu. Remember all that?
Weird.
Right.
It sounds like it's like a virus or something.
Exactly.
So, and if you're married filing jointly, the property tax deduction has now been increased to $40,400. If you're single or married filing separately, is $20,200. So just realize it's like half of that, which is good for people in states that, like me, like in New York, California, higher tax states. They're able to write off more for their taxes. You also get some tax credits. Now, some of the tax credits have changed with the one big beautiful bill. I just want to warn you on that. So there are some tax credits for improvements. Just know that like when you're getting an improvement to your home, and it may not be like a something that you need to do. Like when we think of like you got to replace your furnace. In my rental, I just replaced an AC. Pray for us.
That's about $10,000. Yes.
Things like that. Like if you have those type of costs that are coming up, I know you're not thinking about it because most of the time we're in the middle of basically freaking out because we got to spend money. But check with your tax preparer, your CPA, see what benefits there are to that. This season, I had a client who replaced a water heater, and they didn't know that there was a tax benefit. I just happened to see it. I forgot where it was some note somewhere in their tax paperwork.
Alanna gonna find them notes. I worked with Alanna this tax season.
Water heater, and I'm like, what is this? And they was like, oh yeah, I didn't submit anything because I didn't think. And I was like, please submit it.
So this is a person that doesn't rent. This is their personal water heater that they replace, and there could be potentially some credits.
Yeah. There can be potentially be some basically some energy credits that are available to them. And then I will say, if you do choose to sell your home, there are capital gains exclusion as a homeowner. A lot of people don't realize that. So as long as you've been in your house, basically they look at it as kind of like 2 out of 5 years, basically.
Right. 2 years.
If you're single, you can exclude 250,000 of the capital gains, and if you're married, it's 500,000 of the capital gains, which can be very helpful. A lot of people do not realize that. So when you're selling your house, make sure you keep all your paperwork, all the settlement paperwork, all of that provided to your tax preparer, so that they can go ahead and put in that exclusion for you, because without the exclusion, then you are going to pay taxes on those gains.
Absolutely. I chuckle a little bit because my mother-in-law, Maxine Edwards, they sold their house back in 2022. And every year she's like, Veronica, this money in my bank account, I don't have to pay taxes on it, right? I said it was under a $500,000 profit. So yes, you are good. Yes, and she lived in that house well over 2 years.
They sure did. I know her in-laws. Those are my people. I love them.
Shout out to Northeast SDA Church in Charlotte, North Carolina. And so I'm glad that you mentioned that, because that is a question people have a lot of times. If you stayed in the house for like 2 years, then you don't have to pay these particular taxes. A lot of times people don't even realize there is a tax. So when people are flipping and doing different things, those are the things to keep in mind. So Alanna, let's move into long-term rentals. What should people that have folks, first of all, what's considered a long-term rental? And what are some of the tax implications they should be aware of?
So long-term rentals are considered when you actually have a tenant who actually signs a lease. So we're not talking about like the short-term rentals, like where your average stay is under 7 days. We're talking about typically you would have somebody who signs a lease. Now, I will say I've seen some people do 30-day rentals. I'm going to tell you, when you do 30-day rentals, please check your laws in your state, because you may end up, not saying that's going to happen, but they're squatters' rights. So, if you even have that option, you may want to check your laws and shorten the terms that you allow someone to stay if you don't have people signing like a year-long or a 6-month lease. But typically it's like a lease that a person signs, and they're going to be there for a significant amount of time.
Okay, so this is not, can a long-term rental be 3 months? Because, in accounting, I think long-term has to be 12 months to a year.
Normally it's 12 months to a year, but tax-wise, is normally they kind of separate it based off of, is your average stay 7 days or less or not. So
we're going to come back to that. You can
have some long-term rentals that are like 3 months, because some people are in the travel nursing business as far as providing rentals for travel nurses. So that's still kind of like, even though it feels like a short-term rental, if that nurse is there over a certain amount of time, that's considered long-term.
Gotcha. So Alanna, what are some deductions, ordinary and necessary expenses that can be utilized for these long-term rentals?
Okay, so the one thing about when you have a long-term rental, you don't have to necessarily worry about if you are itemizing or not, because with a long-term rental, this goes on a Schedule E, and you can deduct, of course, your mortgage interest. You can deduct property taxes, any insurance that you have paid, if you kept up any utilities, if you have property management fees. So if you're using a property manager, I think on average, it used to be 8%, but it seems like the average now is like 10% for property managers. So those fees you pay to your property manager every month, any fees you paid if you had your property manager do the work, like as far as finding a tenant, they normally charge you a fee for finding your tenant, and then like a portion of like their deposit or something like that. And so you're able to write that off. If you pay for any professional like services, like a lawyer to create any like contracts, or even if you are providing, now you don't necessarily have to do this, but just saying, if you are providing any like services, like maybe you have somebody else come out and do the yard work because you have like an HOA and you don't want those type of problems or something like that. Your HOA fees, you can write those off also. Any advertising you did to, if you didn't have a property manager and say you're doing it on your own and you're like putting out ads and things like that, any background checks you ran. And then, of course, our favorite of all, which does not happen until you file taxes, is depreciation.
Yes, we love that fake money. Depreciation doesn't come out of your bank account, but it does help reduce your taxable liability. So, Alanna, I want to piggyback off of some common misconceptions. You mentioned we can write off mortgage interest, but not the mortgage payment. Please tell.
No. And I'm going to tell you, as a person who did taxes herself, right? But when I bought my house and decided to make it a rental because I was moving, I was tight. I knew better, but you don't realize until you look at how much you paid out and how much you write off.
Right. Like the math ain't mathing.
I'm like, wait a minute. No, you cannot write off your mortgage principal. So it's very important for you to take into consideration when you are setting your rental prices, like making sure you cover that mortgage, but also make sure that and I didn't mention this, you can write off any repairs or anything you have done to the home.
Definitely.
But make sure that you take in consideration your mortgage, your interest, your insurance, any repairs that may come up, because basically you need to have money available if your tenant has an issue at the house. Right. I will also say, I mentioned that I just bought a new AC unit for my rental. I cannot write off the AC unit. What? That is a capital improvement. It is over $2,500. So it is added to the cost, which affects the depreciation. So it's added to the fake money, as Veronica said.
Right. Well, it's added to the value of the house. It's helping appreciate the value of the house. So it's not considered just, a regular expense. Now, let me ask you this, Alanna. Can folks, because this comes up, that own the house be the property manager and take an expense?
You can. I don't. I'm my own property manager. I did have a property manager initially, but I just realized, like, typically over the years, my tenants haven't had that many issues like that needed, like, for me to just jump up and go there. So I decided to manage it myself. I also had a friend who she has like plenty of rentals, and most of them are out of state. And she showed me how she manages those rentals. And I was like, I could do that. Now, so you can be your own property manager. I would say if you did that, now, if you just have one property, don't do this. But if you have multiple, you can set up a business where, like, you're a property management company, and basically you're handling all the property management for these homes that you actually own. I would say have at least maybe 4. Like, you have to make it make sense, because a lot of times we want to set up a business and we don't think about the administrative costs. It makes no sense for me as a owner of one property to do this. But if you have multiple, you definitely should do it.
Ooh, great advice. Because I get that a lot. People are like, well, I'm cleaning and I'm the property manager. Can I be considered almost like a contractor, an expense? And I was like, I think there's no problem with that. So I'm glad that you cleared that up. So now let's kind of pivot, Alanna, to where the IRS is saying it's short-term rentals, the 7 days or less, or what we know more in layman terms, Airbnbs. And what is the tax difference between a traditional long-term rental and an Airbnb?
Okay, so the IRS, I'm trying to think when they came out with this. It was fairly recently, like after 2020, where they had to distinguish the difference between short-term rentals and long-term rentals, because Airbnb and Verbo and what is it? Is there a way? There's so many little companies out there now that are doing this. Like, they had to do something, because Airbnb has become very large. Shout out to them. So a lot of people, are making money doing this, and it's helping them supplement their lifestyle, or supplement, like, especially if they have like an ADU or a basement that's finished, it's helping supplement.
What's an ADU for those?
Dang, what does the A stand for? I had it when you said
dwelling something.
It's dwelling unit.
I'm gonna Google it.
Additional dwelling unit. Yeah, let me look it up real quick.
We're gonna Google it.
I had it in my head and it left me just that quick.
Accessory.
Okay, accessory dwelling
Dwelling
unit. There
unit.
we go.
An
Thank you.
independent residential living space located on the same lot as a single family home. Boom.
Yes. So actually, now we have gotten approvals that we can have ADUs here.
Come
in the
on,
city.
money. Come
Yes.
on.
I'm not doing it. I mentioned it to my husband though, just out of fun. I knew he was gonna have a whole fit because just a side note, New York is tenant friendly. They are not landlord friendly. So my husband was a landlord here before. He's just not. Yeah, he's like, no, I'm good.
Gotcha.
But if you have one, you can rent out your space. So with the IRS, they basically said if your average stay is less than 7 days, it is not a long-term rental. So it's not considered a Schedule E. It is considered a Schedule C, which is a business. It's an active business that you are running. And because it is an active business, there's differences to the tax implications. Because with a long-term rental, you don't have to pay self-employment taxes. And, we've talked about self-employment taxes on here before. That's 15.3%. But as a business, Schedule C, you are subject to those self-employment taxes. Also, with long-term rentals, those are considered passive. Even though you might feel like you're doing a lot of work, let's be real, you're not. Like if you just have one, now if you have like 4, then I could see. And I keep saying 4s because like the IRS really considers you a professional like real estate investor once you have 4.
Okay, good to know.
So I would also say consider that as doors also, because sometimes I'm gonna say if you're smart, you'll get a multifamily.
Yes, I'm taking my notes.
Doors. Yeah.
Yes.
Multiple doors. So if you have 4 doors, basically that puts you in the professional status.
Outside doors.
Right. And you have to put in a certain number of hours. So that's also a piece of it. But it's considered passive. Like the Schedule E, like for me, I put in that AC, but I'm not going there. Like
you're not turning the rooms every 7 days.
I'm not doing all of that. So it is very passive. Whereas when you have an Airbnb, you think about even if you're outsourcing your cleanup and stuff, you are coming over there. It's more active. You're making sure the bookings, making sure like, okay, is this somebody I want to approve for booking? All that stuff. You putting it out there. You're keeping the dates open and closed and whatever.
It's giving hotel. It's giving hotel.
Yeah. So it's an active business. Also with the short-term rentals, you can offset your W-2 income. You can't do that with long-term rentals. Okay. So long-term rentals are considered passive, and because they're considered passive, any like losses and stuff like that you have, you can only write off up to the amount of income of passive income that you've received. So if your long-term rental made $20,000 in revenue, if you had, hopefully you don't have this amount of losses, but it happens. If you have 30,000 in losses, then you can only write off the 20,000, and the extra 10 is carried over. It's carried forward. You can use it in remaining years. So that's something else that you have to think about. And then, you get to depreciate your long-term rental. Now you can do, and I'm going to say long-term depreciation. So, 27.5, unless you do cross-segregation, which is a tax planning strategy. But
we're going to talk about that. That's a whole nother show. Right.
Right. But with a short-term rental, you typically only can use a bonus depreciation. So.
Ooh, Alanna, so many jewels, because I reached out to Alanna. I think it was back during Black History Month. I was teaching a class at the Small Business Center, and I met an amazing homeowner that has short-term rentals. And she was asking that question. She was saying, well, this is always on a Schedule E. And I was like, I'm not sure that short-term rental can be on a Schedule E. And Alanna, we hear it all the time. Well, I've been working with these great CPAs, or everybody has a podcast giving these different tips. And I'm so glad that you've been saying this throughout, Alanna. Check with your state, check with your CPA. But some of these laws are just federal. Doesn't matter where you're located.
Yeah, it does not matter. The IRS came out with guidance, and it seems like, well, I'm not going to knock anyone else, right? It's just if that client may be their only client with rentals, sometimes it makes it rough. But even when they came out with it, it was just kind of like a big thing. Everybody was looking into it. And even for me, I have a client who is a professional real estate investor. They have another business, but truthfully, well, let's just say they're not, because they have another business. But but they have several properties, probably have like 5 properties.
Nice.
And one year they decided to make 3 of them Airbnbs. So we had to
Child.
change their whole tax return, and it affected them differently. And they was pretty upset, but I was like, you should have told me that. You told me when we're filing. If you would have told me ahead of time, I could have gave you some guidance on this. But then
Right.
also another thing I'm going to mention, because this is what happened to that client. If you have a rental and you decide you want to do Airbnb, and they have that rental is set up in an HOA, like that neighborhood has an HOA, you need to check those HOA bylaws. Because what happened to my client is that they had those Airbnbs, and then the HOAs came and was like, oh no, you can't have Airbnb.
Right. It's like almost having
And
a
it was
tiny
something
home.
that came up later. Yeah.
Mm-hmm.
Because nobody was really thinking about it, because Airbnb was not that big. And then you realize you're having a lot of people coming in and out, and then they set new rules. So basically, my client went from having 5 long-term to 2 long-term, 3 short-term, back to 5 long-term, because those 3 houses happened to be, which was so sad, because those were his biggest properties, and they were perfect Airbnbs. Like, they made a lot of money. If you're able to do it, I would, and you're willing to put in time,
Right.
good method. But they had to turn them back into long-term rentals.
I'm so glad that you said that. And it doesn't matter what makes more money. Like, oh, it makes more money, so I'm going to make this long term. It doesn't matter. It's based off of the length of time folks are staying that determines the tax law. And I'm so glad that you brought that up, and just continue, folks, to reach out. Not just when it comes to a house, anytime that you have a major purchase, if you're going to be spending more than $5,000, reach out to your CPA. Also, if you are changing things or things have happened throughout the year, reach out to someone like Alanna or myself before October, because I feel like, Alanna, there's different things that we can put different funds in different financial instruments before October, and then we can save you some money. Even if I know some things don't have to be funded until next year, some things have to be set up by October. So this is the time, this is going to be airing in July, that you need to start working on your tax planning.
Exactly. Perfect. Because a lot of people wait till December, and in December, there's not going to be much available. It just is what it is. There's a lot of different methods you can do, but it's a little late in December. You might slide in there, but typically it will cost you a lot of money to do it.
Oh, we like when they come in, because we like, okay, it's, we'll do it, but it's for a price. But
yeah, it's gonna cost you a lot of money.
Exactly.
And it's not because I'm charging you. It's just because you're last minute. There's only so many options.
Exactly. So, Alanna, we're already to the end of the show. Is there any final thoughts when you think about your 20 plus years of experience doing taxes? You have quite a few real estate clients. What is the biggest thing you want people to walk away remembering about this conversation?
I just think, you have to think about who you are as a person and what you want to deal with. It's okay if you change your mind. Right. And the reason why I say this is because everything sounds great until you start doing it. When my house became a rental, truthfully, because I moved, but my initial thought process was to flip that house in 2 years.
Right.
That was my initial thought process. But then the market fell out.
And how many years now has it been that you've been renting? At least 10. You've been married 10 years.
I've been 11 years. I've been renting for 11 years. Yes. I've owned the house for 19 years.
Oh, yes. And it was supposed to be, I'm just going to flip it.
I was basically going to live in it, flip it, do my 2 years so I can get my tax exclusion, and sell it for a higher price, move on to the next house. And that's what I was going to do. And the main thought process was to build into multiple rentals.
Right.
eventually I decided I didn't want multiple rentals. And I'm doing it a different way. Like I'm investing more on like real estate investment trusts. So
Right.
I would say like it's okay to try it, and if it doesn't work out, to do something else. But just make sure, the main thing I want you to understand is if you're deciding to get into the rental game, whether it's short term or long term, talk to someone first. It is always worth it. I think I've said this on here before, but I preach this all the time to people. It's always worth it to pay the consultation fee and get a full understanding before investing thousands on thousands of dollars.
Yes. Yes. Cheap is very expensive. Pay the money up front, do the research, also talk to people. I heard Alanna, you say, I have a friend that has multiple real estate properties and she's managing it remote. So find people that are doing the things. You'll be surprised how many folks own properties if they're members of your church, family members, people that you work with, Facebook groups, social media. So I'm so glad that you mentioned that you can change your mind, do the research, and spend a little bit of a coin with Alanna Anthony with Amplify Accounting and Consulting.
Amplify.
Yes. So we'll have all of Alanna's contact information as always below. Alanna, thank you so much. You're always so helpful, providing our final advice for season 6. We appreciate you so much. We can't wait to see the renovations in season 7. And thank you to the V team again for everybody for tuning in this season. Don't forget to subscribe on YouTube. And as always, stay balanced and financially savvy.